Money on my mind, looking for a dime. James Locke in the house, gonna help you shine.
Welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer some of the Ask James questions of the day. And we have this first question from Paul, who says, I'm age 49 and I'm trying to figure out if I want to retire early or stay working. What should I consider? Well, I think there's a couple of factors. And I think the biggest factor, Paul, is to really think about what you want in retirement. We always talk about the money a lot, right? And compounding money, and early retirement means less Social Security, more medical costs. But what's your retirement look like? Why are you thinking of retiring? Are you thinking of retiring because you don't like your current situation? Or you're thinking of retiring because you're moving forward towards something that's pleasurable? Because if you're moving towards something that's pleasurable and you're retiring, let's say in your early 50s, now you want to make sure that you have enough income to stay retired, right? You want to make sure you have a buffer. This is where you take what you have, you multiply it by 5%, 6%, and say, between that and Social Security, is that going to give me a 40 to 50% buffer, extra income for the future that I may not need right now? Because you need that buffer to make sure you can stay retired with inflation and home health care costs and everything else. So part of it is you are moving toward or moving away, right? Now, if you're moving away, and it's not just from a bad boss, it's moving away from an occupation that you don't like anymore, right? But you can't be repurposed in many places, so you're thinking, what do I do, right? Then okay, maybe it's okay to retire early, knowing that you're going to work part-time for a period of time, because for you, it may not be that you've got this grand dream of retirement, right? Because remember, part-time work gets in the way, right? If people have this dream of all the travel and all this great stuff they want to do, but they have to work part-time, even if it's 2 days a week, they still don't have the flexibility they want. That's why people who are moving towards, something typically want to work a little longer to make sure they can retire and they have that buffer, right? But people who are moving away from something because, maybe their occupation is being replaced by AI, or they don't like what they do anymore. Now, if that's why you're retiring, not because you're moving towards something that you've already dreamt about for years and wanted for years, then okay, maybe it's okay if you work part-time for a longer period, or do some consulting for a longer period, or live on a little bit less income, in which case you might have to be willing to downsize, right? Get into a smaller place, because if that's more pleasurable to you than continuing to work and living in a nicer place, well, then that's only the decision you can make, right? Let me dive deeper into the critical considerations for early retirement, at age 50 or whatever it is, right? It's like a financial readiness checklist, right? You really need an income replacement strategy. Calculate your precise annual expenses. Develop a sustainable withdrawal strategy. That's typically that 4 to 5% of total assets. Create multiple income streams. You want investments, potential part-time work, like consulting, right? Build a robust emergency fund covering 2 to 3 years, even more, of expenses. Now, you have to do some healthcare cost planning, right? So budget for private health insurance until Medicare eligibility at age 65, of course. Monthly costs can be $800, $1,000, $1,500 per person per month, right? So consider health savings accounts as a kind of a tax-efficient healthcare funding mechanism. Factor in potential long-term care insurance needs. Now, lifestyle sustainability, right? That's important. You want to assess that. So conduct a comprehensive lifestyle audit, right? Categorize expenses into essential and discretionary spending. Develop flexibility in your budget to accommodate unexpected costs. Create a worst case scenario financial plan. Now you have to have a psychological readiness evaluation, right? Identify kind of a transition, right? Prepare for the emotional shift from professional identity to retirement. Develop personal projects, hobbies, meaningful activities. Consider volunteer opportunities or part-time meaningful work. Create a structured daily routine to maintain mental engagement. Now, there's also relationship dynamics. You want to discuss retirement plans extensively with your spouse, right? Align mutual expectations about lifestyle and spending. Develop shared goals for retirement years. Consider how increased time together might impact your relationship. Now, there's investment and income optimization, right? You're going to want to do some portfolio rebalancing, most likely. Shift towards more conservative, income-generating investments. Diversify across dividend stocks, bonds, real estate investment trusts. Maintain some growth-oriented investments to combat inflation. Consider maybe annuities for guaranteed income streams. Now you want to have some tax efficiency as well, right? Understand tax implications of early retirement withdrawals, right? Strategize Roth conversions. Optimize Social Security claiming strategies, right? Explore tax loss harvesting opportunities. Now, there's some flexibility factors you're going to want to look at as well. You may want to maintain a professional network for potential consulting opportunities. You want to keep skills kind of current through learning or occasional project work. Be prepared to adjust plans based on market conditions. Consider geographic arbitrage, right? Moving to a lower cost area. Maybe some final considerations. At age 50, you're in a unique position to craft a personalized retirement approach. No one-size-fits-all solution exists. So continuous reassessment is key. Prioritize personal fulfillment over rigid financial metrics. Hey, Paul, good luck making the decision. I'm sure you'll choose the right thing, whatever it is. Remember, retirement is a journey, not a destination, right? Your plan will evolve, and that's perfectly okay, Paul. Hey, thanks for the great question. And if you'd like to send in your question like Paul did, you can do so. You can email it to poollocke@poollocke.com. Moving on to our second question, and this is from Candace. Candace is wondering, how much money do I need to have in a diversified portfolio in order to invest outside of mutual funds and ETFs? Great question, Candace. Let's dive into how you can effectively diversify that portfolio outside of mutual funds. Especially with a focus on generating income in retirement while minimizing risk and volatility, because those are the things we need to factor in, most importantly. Really, the landscape has evolved significantly, right? Particularly with the elimination of trading fees and commissions by major platforms like Schwab and Fidelity. This means that even with a relatively modest amount, say $50,000, you can cost effectively build a diversified portfolio of individual stocks. Platforms like Robinhood have played a role in making low-cost trading accessible, and this trend has been adopted by larger brokers, right? Benefiting independent investors. However, the challenge arises when you consider kind of integrating bonds into your portfolio, especially as you approach retirement. Now, bonds typically require larger investments to diversify effectively due to higher kind of transactional costs and liquidity constraints. For instance, purchasing individual bonds under $5,000 each can be inefficient and may limit your ability to trade or sell them if needed. As a rule of thumb, I would recommend aiming for around $250,000 in total investments before integrating bonds into your portfolio, particularly as you near retirement age. This amount allows you to diversify across stocks and bonds while managing costs effectively. Younger investors focusing primarily on stocks may be able to achieve diversification with less capital initially, but as you transition to a more balanced portfolio with income generating goals, having a kind of higher amount like $250,000 ensures you can maintain a diversified and resilient investment strategy. Candace, the goal here is to ensure your portfolio is structured to meet your income needs in retirement while minimizing risks associated with market fluctuations. Diversification remains key. And reaching a certain threshold like $250,000 can significantly enhance your ability to achieve this effectively. I hope this clarifies things for you, Candace, and provides a solid foundation for making informed investment decisions tailored really to your specific financial goals. Thanks for the awesome questions today. And as always, if you would like to send in your question, you can do so. You can email it to poollocke@poollocke.com. If you like what you heard, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source. I'll see everyone next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the bank.